The Rand refinery just outside Johannesburg. It's hot and sweaty. The crucible is at 1,200 degrees as workers prepare to pour another batch of gold bars. These are so-called London delivery bars. Chemicals are added to ensure purity of 99.5%, the South African standard. The result? 12.5 kilograms that feels as good as it looks. At the moment it was poured, this bar was worth 3.7 million rand, just over $500,000. By the time it's flown to a bank vault in Europe, it's likely to be worth quite a bit more.
Well, the big fundamental factor underlying the rise in the gold price is the extent to which the world's monetary authorities have just been printing cash in the last 2 years to try and extricate the world out of its recession. When you print so much cash and you don't get a commensurate response in real economic activity, which has been the case, that money has to go somewhere else. And of course, gold is the leading hedge against the ultimate potential inflation that could occur from all this creation of money.
The Rand refinery moves 400 tons of gold a year. One problem is falling production in South Africa means there's not enough South African gold to keep this refinery going.
In the early 2000s, our average gold from South Africa was about 80% of our total throughput and about 20% from the rest of Africa. Today it's about 50-50. So yes, we've seen that decline from South Africa, but we've seen a steady increase coming out of the rest of Africa.
To process this newfound supply from countries like Ghana, Mali, Burkina Faso and Tanzania, this refinery is installing new machinery that will increase output by 20%. On November the 27th, it'll be 90 years since they started refining gold here at Germiston in the East Rand, just outside Johannesburg. In fact, 1/3 of all the gold in the world was refined here. In recent years, the value of that gold has soared. Theories abound about gold's meteoric rise. Undoubtedly, the collapse of the US dollar has sent many investors looking for a reliable hedge. Low interest rates in many countries are a factor, and many analysts say even the development of new instruments to trade in gold has helped pump up the price. It's been a 30-year rise for gold. In January 1980, prices reached a then record high of $850 an ounce as Russia invaded Afghanistan. In April 1999, prices fell to a low of $251.70, over fears that central banks were likely to reduce their reserves of gold bullion. In 2003, the price moved up to a 4.5-year high in the run-up to the war in Iraq. In December 2009, gold hit another high of $1,226 an ounce, thanks largely to a weak dollar. Then, on September the 27th, gold reached a record high of $1,300 an ounce, as economists struggled and the dollar hit an 8-month low. And it's far from over yet, according to South Africa's gold guru, Clive Roffey, one of the top technical analysts in the country.
We produced a forecast at $1,285. It's made that. I'm very happy about that. If we see gold break through 1320, I'm expecting to see gold have a very strong run and then bounce right through to $1,600, $1,700 an ounce.
So is the gold price destined to go up and up? What could bring it down?
I do not see this big recession is beaten scenario panning out over the long term. The best I can see is that we crawl along the bottom of growth for quite a period of time. In that case, I think people are still going to look for a risk, a hedge risk. So I really don't see the gold price coming down.
These are very interesting times to build gold into your portfolio, according to Adrian Saville of Cannon Asset Management.
A sense that perhaps we could be moving into a period of deflation, which is falling prices. And in those conditions, gold would be a very good asset to hold. And just a sense of increased turbulence, and gold in this case presents a safe haven asset.
What sort of advice would you give to your clients about gold at this time?
I think the problem in trying to figure out how gold fits in is you need to have a firm view on the economic scenario that unravels, which means quite reliable forecasting. And to be more specific, for gold to work in a portfolio, in a South African portfolio specifically, what you want is arguably a much weaker rand than we currently have. You want at least the current gold price, if not higher. So you need to forecast those two components, which both are really tough to figure out, commodity prices and currency. But on top of that, you also need to apply your mind to whether you think global markets are going to come under a fresh round of pressure or stress from a sovereign default. I think that would cause tremendous appetite for gold. And also if consumer prices are going to move into a deflationary trend or falling price trend. And if any of those scenarios pans out, then I think there is a particular place for gold or a proxy to gold in your portfolio.
Anglo has said it's going to wind in its hedge book. What do you think this is telling us about the future of the gold price?
It gives you a very good sense of what the insiders in the industry think about gold, and that might help you make a portfolio decision. In short, what Anglo Gold is doing is buying back their hedge, and so they are reversing the contract that they had to sell gold at much lower prices.
Now, at this particular time, would you prefer to hold gold or platinum?
I've got a structural preference for platinum, and there's a range of reasons for this. I think the mining industry in South Africa, the deep mining industry, which means gold and platinum, has a number of structural pressures that they have to face, including substantial wage inflation and electricity inflation. Both of these are important input costs to the deep mining businesses. But platinum enjoys a specific advantage in that it's a very concentrated industry. And by contrast, gold is highly fragmented. The deep gold industry in South Africa has been suffering on top of this from falling yield for a number of years, making gold more and more expensive to get out of the ground.
Looking ahead, what is your forecast for the gold price?
Well, having made the point that I think forecasting commodity prices and currencies is extremely difficult, perhaps I can fall back on that hedge and say that trying to make a spot prediction about if gold is going higher or lower from here, I think that's a really difficult call. My view on the world economy is that we aren't done with the stress yet, and I've got an alarm bell hanging around the necks of sovereign debt. I wouldn't be surprised if there's a sovereign default. And we've got governments printing money with wild abandon. Put those two together, I think that tells you that the gold price must go higher.
So all that glisters is likely to be worth a little bit more by tonight.